Are you in charge of selling an estate property? This can be especially tricky, but the taxes can be even more confusing. So we are here today with tax professional Nikali with Simplified Tax and Accounting in Lansing to answer all of the questions that come up with frequency when we work on estate properties, which is with frequency, yeah, quite a lot. So I guess the first question is, when an estate is being sold, how are the taxes calculated? How much tax am I going to owe when I'm selling mom and dad's house, for example?
This question comes up all the time. So the key point is almost all assets, and houses are one of these assets, get what are considered a step up in basis upon death. So mom and dad bought the house for $10. When they died, it's worth $100. To the estate, the property cost $100. So that $10 to $100 it vanishes upon death. So that the property is now inside the estate at $100, as if the estate paid $100 for it. So assuming that the estate sells the property within 6 months, then we normally make the assumption that
It's about the same.
Yeah. So there's no gain on sale of property that flows through the estate normally.
Is that the same if the estate is owned in a trust?
If the property is owned in a trust, so all assets, either directly inherited or through an estate or a trust, all get that step up in basis for any asset that has already been taxed at least once. So retirement accounts don't count, but if it's a bank account or investment account or property, it all gets that step up in basis upon death.
So that brings up another question, because a lot of the families that we're working with, say mom and dad have passed away, but it's really emotional, and it took me 2 years to get the house cleaned out and on the market. So now is that going to change the answer?
It will change the answer. So if we don't have an appraisal at death, which normally we don't, then typically we use 2 times the SEV or any sort of comparable sale we can get to determine what the cost was, what the fair market value was at death. Because again, that fair market at death becomes the cost basis to the estate. Then if there were improvements that occurred between death and sale, we'll add that to our new cost basis, and that will determine if there's any gain or loss inside the estate or trust.
Okay, so that's for like larger capital improvement, like a roof or a furnace or something.
It depends, because in theory, once that property is inside the estate, it's an investment property now, right? This is not personal anymore.
You're not living in it. Yep.
So in theory, all upkeep until time of sale could be rolled into the basis and determine any normally ends up being a little bit of a loss, honestly.
And if you think that it's going to make a big difference in your situation, maybe you think the SEV is not a good way to go, there is something called a retroactive appraisal, where an appraiser can do an appraisal as if it was that date, or even contact us as real estate professionals, because we can do a search for the time frame needed to zero in on what the value would have been
at that time.
Right, it's way better than the SEV. Man, it works.
Yeah, you might create a bigger tax liability.
Exactly right. So if we have something we can, especially if we have a gain situation, we have something we can rely on. Great. A lot of times what happens, we end up with a loss because we have some of those carrying costs, we have closing costs. So then we end up with a loss inside the estate that can be passed through to the beneficiaries. They can actually take a tax deduction
on their own
personal return from the sale of that estate property.
And I'm sure siblings have never argued about that ever.
Well, at least if I give them news that they get a deduction, then it usually helps the scenario a little bit.
Yeah, they never argue about selling the house either. It's never happened. Ever.
So can you use, in addition to like the capital improvements, all maintenance costs, so like getting the grass cut, utilities?
All that would add to the basis of the property, as if it's an investment property.
Okay. Insurance.
So
they're going to want to keep track of improvements and estate.
Which is good from a tax perspective and also from the estate accounting perspective, right? Because usually there's one person that's the executor or trustee, and so they'll have to justify sometimes to the other beneficiaries how the money was spent. So they should keep track of it for tax purposes, but also for their own accounting purposes as they settle the estate through the process.
Right. Okay. It's an estate. You're selling it for mom and dad, but it wasn't their primary residence. It was a rental property. Does that change anything?
Normally, it depends on how the estate handles that property. So if the estate decides it's going to continue to rent the property or the trust, potentially a trust would, because that can live longer than the estate normally, then it would start over the depreciation process inside the estate or trust. But again, the nice thing about that is all the prior depreciation goes away. So, mom and dad bought the house for $10,000, they depreciate down to zero because they've taken that depreciation. They get a whole new, brand new step up in basis. All the depreciation goes away.
Isn't there like you get $6 million or whatever it is?
So there is a state tax and then there's a state income tax, right? So you're allowed to have $10 million at death without paying a state tax. That is the death tax that you hear about.
Okay.
A state income tax is kind of what we're talking about inside this current situation.
So funds that were earned.
That's right, after the
still
time.
Because you still have tenants living in that property from.
And normally what I see is that usually the people want to sell the property, the trustee or the executor wants to sell the property pretty quickly. They don't want to continue to be landlords.
Sure.
So, again, you may have 6 months of rental activity, but you get that huge step up in basis, the depreciation goes away. So when you do sell that property, you'll have very little gain, even though it's been a rental property for potentially years and years.
Decades. Well, and it could be more relevant if you have a larger portfolio. I mean, we've worked with some estates where
20 properties
easily or more, and so it takes longer.
while.
You don't want to put everything on the market because now you're your own competition.
That's
So
right.
there's some strategy behind that.
And honestly, when I'm talking with some clients that do have a large portfolio and they are up in age, they don't want to manage it anymore, right?
Mm-hmm.
But the tax savings for them to wait until death can be significant. So either kids step up and manage, or they hire management property because it could be, a lot of depreciation would be recaptured if they sell it before death. So postponing till death could be a major tax advantage.
And use the money that you spend on a property management company as a
as a deductible expense to the individual as exactly right. So it'll dollar for dollar reduce the taxable income associated with that rental if they do use a management company.
Dang, yeah.
So if you have any other questions about estate taxes or how to handle that, please definitely feel free to reach out to Nikali at Simplified Tax, and the contact information is down below.